CPI inflation still running hot over 8%. Is the Fed put dead? One of the worst starts for bonds in history. Can bonds rebound from here? The Super 7 market darlings have fallen. Market corrections since World War II, where do we currently stand? Good afternoon and welcome back to another market update. Today is May 11th, and earlier this morning we received April inflation data that was higher than expected. In fact, still over 8%, although lower than last month. Keep in mind, CPI inflation is measured on a year-over-year basis, so these prices are compared to a year ago. Here's a quick look at how some of the numbers shake out, again considering the comparison to a year ago. Gasoline, of course. We've talked a lot about used cars, which actually have gone down 3 months in a row. So maybe we've hit a peak in used car inflation. New car prices at 13% versus a year ago. Meat, we know that story. One part of the transportation section is airline fares, which were something like 26% over last year. The market's reaction has been temperamental. First down, then up, then down. So we believe trying to trade around CPI releases just doesn't contribute to long-term results. Bottom line is, in markets, better or worse is more important than good or bad. And at least for the time being, it appears inflation is starting to turn the corner.
That begs the question, is the Fed put dead? Well, what is the Fed put? It's the theory that if the stock market goes down by enough, the Fed will change its course and lower rates, become more dovish or supportive of the economy and the stock market. This happened in Q4 2018 and again during the COVID crash. The Fed always says it's focused on jobs and inflation. With such a tight job market, obviously the Fed's turned to inflation. So what's a great way to quickly reduce inflation? Not through the supply chain. That's going to take some time. It's to engineer a reverse wealth effect. Well, what is the wealth effect? Very simple. When people have more money, when account balances are higher, we spend more. Go figure. But the same thing also works in reverse. When account balances are lower, we spend less, which may be precisely what the Fed wants. Just look at consumer confidence, and it appears the Fed's wish may be granted. So whereas before the Fed was thought to be supportive of the market, perhaps that's changed, and the Fed put may not be as reliable as it used to be. We don't believe it's gone for good, but it'll take a lot more than a bear market to bring it out again.
Yet another uncertainty to add to the pile. One of the most challenging parts of this year we've been talking about is stocks down, bonds down. Here, we're looking at the bond benchmark, the Bloomberg Aggregate Bond Index. These are the annual returns for the index since 1976. So you can see some high returns in there, especially for bonds. And in fact, the index has finished down for the year only 4 times in the past 45 years. So when we're talking about the role of bonds in portfolios, this is one consideration. Will the future be like the past? Definitely a conversation for another day. But this year so far in bonds being one of the worst in history, we're cautious to give up on bonds full stop, and believe as inflation begins to ease and perhaps as rates moderate, then bonds can rebound from here.
Turning to the market darlings over the past few years, some are calling these companies the Super 7. They've also been referred to as the FANG stocks over the years. These are the largest companies in the US, and they make up large parts of the S&P 500 and NASDAQ indexes. Look at these drawdowns. Facebook, which is now called Meta, down 50%. Nvidia, a computer chip maker, 50%. Amazon, unstoppable Amazon, peaked almost a year ago, down over 40%. That's a $1 trillion company. Tesla, we know it's volatile, down 35%. Google, now called Alphabet, down almost 25%. Microsoft, over 20%. And even Apple, down 15%. And even with today's action, getting close to 20% from its peak. Add this to all of the other carnage that's happened. The Russell 3000 is made up of over 2,700 stocks. The index itself is down about 18%, but look at how many stocks are down much more than that. 44% of the companies are down by more than 50%, and 85% of those companies are down by 20% or more, what we would consider to be a bear market. The good news, yes, I said it, the good news is that this is all in the past. We've absorbed this drawdown. We've already experienced it. And now, stock market valuations are lower than before. The market is cheaper, a better value, and that makes forward returns much more attractive.
This has truly been a historic year. As the S&P 500 is currently down about 15%, we'll leave you with some other corrections since World War II, listed from oldest to most recent. These are all the corrections, which we're broadly referring to as a drawdown of between 10 and 20%. You can see the average time of a correction is 133 days. Today being 127 for this current drawdown, we're currently getting close to the average in terms of time. Of course, we shouldn't expect historical average to precisely predict the future, but at least it does provide a frame of reference to view the current correction. This is the not so fun part of investing, but part of it nonetheless, and a big reason stocks deliver higher returns over the long term. Thanks for watching and have a great day.